7 business days. That's all that separates this moment from the April COMEX first notice day, and yet the clock isn't the most important variable. The structure is. Because while the paper price of silver slips toward the mid-60s, something quieter but far more important is happening beneath the surface. Over 9.6 million ounces are still standing for delivery, at the exact moment when COMEX registered inventories sit near 78.95 million ounces, down roughly 67% from 2020 levels. And just days ago, 2.03 million ounces left the vault in a single session. So let me ask you something, and I want you to really think about it. What kind of market sees price falling while the physical supply is disappearing faster than it's being replaced? Because that's not volatility, that's divergence. The CME system is still quoting a price, the Federal Reserve is still guiding expectations, but the vault, the only place where promises become metal, is telling a different story entirely, and the people who understand that distinction are not trading the ticker anymore. They're watching the inventory. Because at some point, those two realities, the price you see and the metal that exists, have to meet. And when they do, it won't be gradual. It will be decisive. Let's slow this down. Because the move you just witnessed didn't begin in the silver market. It began with a single word from the Federal Reserve, not a hike, not a cut. Just a shift in expectation. On March 18th, the Fed held rates at 3.5% to 3.75%, exactly as forecast. But what wasn't priced in, what the CME FedWatch tool immediately began recalibrating, was the signal of only one rate cut for all of 2026. One, in a system that had been leaning on liquidity. That word didn't adjust positioning, it broke it. And the reaction was immediate. Silver, trading above $77, collapsed toward the mid-60s within 24 hours. Not because the metal changed, but because the cost of holding it did. Yields moved, the US dollar index pushed higher, and suddenly, every leveraged long position in precious metals found itself standing on thinner ground. This is the part most people miss. The Fed didn't attack silver. It removed the condition that was supporting it. Because when capital realizes that easing is not coming, it doesn't wait. It exits. Fast, mechanically, without emotion. So what you're seeing in that drop isn't weakness in silver. It's the system repricing the absence of relief, and once that realization settles in, the next move is no longer about expectation. It's about survival. 7 days. That's the distance between now and delivery, and yet the market isn't reacting to time. It's reacting to shock. Because while silver is trying to stabilize, the real story isn't in the chart. It's in the Strait of Hormuz. Right now, nearly 20% of global oil flow is under disruption. And in the past 48 hours alone, crude has surged back above $100. After swinging violently between a 119 spikes and sub-100 reversals, as U.S. strike delays collided with Iran's outright denial of negotiations. Think about what that means. This isn't just volatility, it's a system struggling to interpret reality. The International Energy Agency is warning that over 40 critical energy sites have been damaged. And even if the war stopped today, the supply chain would not recover quickly. So when oil behaves like that, up, down, reversing within hours, you're not watching a commodity, you're watching inflation expectations being rewritten in real time. And that feeds directly into the Federal Reserve's constraint. Higher energy, persistent inflation, no rate cuts. And silver? It sits right in the middle of that chain. Not as a safe haven, not as an industrial metal, but as a reflection of how unstable the system has become. Because once energy stops behaving predictably, everything else follows. And that's where the next phase begins. Now pause for a second. Because what you're seeing on your screen isn't just volatility, it's disagreement. Not among traders, but among the system itself. At the exact same moment, Fortune prints silver near $69. FX Street shows 64.58 SECs, and CBS reports around 68 SECs. That's not a normal spread. That's a fracture. Because in a functioning market, price is a consensus. Here, it's a negotiation. And when 3 major financial outlets, each pulling from institutional feeds tied to CME futures, LBMA benchmarks, and interbank liquidity, cannot align within a $5 range, you're no longer observing a single market. You're observing layers. One layer is reacting to Federal Reserve policy, rising yields, and dollar strength. That's your paper market. Fast, leveraged, liquid. The other layer is slower, tighter, constrained by what actually exists in vaults from COMEX to London. That's your physical market, where delivery, not sentiment, defines reality. And when those two layers begin to drift apart, something deeper is happening. The mechanism that normally keeps them aligned, arbitrage, is starting to fail. Not because traders don't see the gap, but because the metal required to close it isn't easily accessible. So this isn't confusion, it's transition. Because once price stops being singular, it starts becoming selective. And that's where the market begins choosing which version of reality it will accept next. Let's go beneath the surface. Because the price you see is not the constraint. The inventory is. Right now, COMEX registered silver sits near 78.95 million ounces. Down from over 300 million in 2020. That's not a cycle. That's a structural drawdown. A 67% reduction in deliverable metal in less than 6 years. And it's not slowing. It's accelerating. In just one session, 2.03 million ounces left the vault, while inflows barely registered. The monthly drainage rate is now running near 22 to 23 million ounces, and the system is starting to reflect that stress. The coverage ratio has collapsed to 13.7%, a level that historically signals strain. Meanwhile, paper leverage sits above 7 to 1, meaning for every ounce that can actually be delivered, multiple claims exist in parallel. Now think about what that implies. The CME framework still functions, contracts still trade, but the moment someone says, deliver, the abstraction ends. And that's where the pressure concentrates, because markets don't fail when prices fall. They fail when obligations exceed what can be fulfilled. And right now, the vault is not rebuilding. It's thinning, quietly, consistently. So the real question isn't where silver is trading today. It's how long the system can keep quoting a price on something that is steadily disappearing underneath it. Now step back, because the pressure you're seeing isn't coming from price. It's coming from demand that refuses to slow down. In March alone, over 10,500 COMEX contracts stood for delivery, representing roughly 52.6 million ounces. That's not a trade. That's a request for metal. And it follows a pattern. January near 49 million ounces. February over 25 million. And 2025 total deliveries surging to 474 million ounces, more than double the year before. So while headlines talk about silver falling, the physical market is doing the opposite. It's pulling harder. The Silver Institute continues to point to a multi-year structural deficit, now entering its 6th consecutive year, driven not by speculation, but by use. Solar capacity expansion, EV manufacturing across Asia and Europe, and the rise of AI infrastructure, all quietly absorbing supply that doesn't come back. And here's the part most people overlook. Mine production doesn't respond quickly. Nearly 70% of silver is a byproduct, meaning supply can't surge just because price moves. So what you're watching is not a collapse in value, it's a separation between who trades silver and who needs it. And when demand is structural, not emotional, it doesn't sell. It waits, and that's where the imbalance begins to compound. Now widen the lens, because this is no longer just a COMEX story. This is global. On January 1st, 2026, China didn't adjust the silver market. It redefined it. Through export licensing controls reported by state media like Securities Times, silver was elevated to a strategic material, placed alongside rare earths. Only 44 companies were authorized to export, effectively concentrating supply, and in doing so, restricting as much as 60 to 70% of refined silver flow from reaching the open market. And the impact was immediate. Shanghai inventories fell from 559 tons to just over 318 tons in 4 months. A 43% contraction. Premiums in Asia held firm at $5 to $10 above Western spot, sometimes far higher. That gap should not exist in a connected market, but it does, because the metal required to close it isn't moving. Meanwhile, in London, the LBMA reports over 27,000 tons in vaults. But analysts like David Jensen point out that much of that is already allocated, locked inside ETFs and private holdings. The lease rate above 5% tells you everything. Holders are not letting go. So what you're seeing is a system losing fluidity, not collapsing, but tightening. Because when supply stops flowing freely across borders, price doesn't unify. It fragments. And once fragmentation becomes structural, the global market stops behaving like one. And this is where the story splits. Because the bearish case is not wrong. Silver has fallen from $120 to the mid-60s in less than 2 months. The Federal Reserve remains restrictive. The US dollar is firm, yields are elevated. And models like CoinCodex project further downside toward the low $50. Even voices like Marko Kolonovich, formerly of JP Morgan, point to historical patterns where metals retrace sharply before any sustained move higher. That argument is grounded. It's logical, but it's incomplete. Because while price is falling, the physical question is getting louder, and no one on the bearish side has answered it directly. Where does the silver come from? Not contracts, not liquidity, actual metal. The kind required by manufacturers, sovereign buyers, and institutions that don't exit when the chart turns red. Yes, there are narratives, manipulation claims, references to past CFTC cases, speculation about bank positioning. Some of those concerns are rooted in history. But today, the data shows something more structural, not collapse, but constraint. Because there is a difference between a market that corrects and a system that runs out. And if those two realities continue to diverge, then the question stops being about direction. It becomes about credibility.